Hello and good evening, everyone. I am Ridhil Mishra from the Corporate Communication team, and on behalf of CareEdge, I welcome you to our today's discussion on non-life insurance, ready to take off. And we sincerely appreciate your time in joining us for this webinar. We would like to welcome esteemed guest speakers for today. We have with us Mr. Samir Shah, Executive Director and Chief Financial Officer, HDFC ERGO General Insurance. Mr. Gopal Balachandran, Chief Financial Officer and Chief Risk Officer, ICICI Lombard General Insurance, and Mr. Rajive Kumaraswami, Managing Director and Chief Executive Officer at Magma HDI General Insurance. The session will be moderated by Mr. Sanjay Agarwal, Senior Director at CareEdge Ratings. We'll commence the session with the presentation by Neha Kadian, Associate Director at CareEdge, which will be followed by a panel discussion along with the Q&A session. You can please post in your queries during the discussion also. And now may I invite Neha to make a presentation, please. Thanks.
Thanks, Mridul. Good evening, everyone. I am Neha Kadian, Associate Director at CareEdge, and today I'll discuss about the ongoing trends in the life insurance, non-life insurance industry and outlook going forward. Synopsis. The health insurance segment, given its high contribution to the non-life insurance sector, will drive the normalization of loss ratio. The claim payout has come down from the peak levels witnessed during the pandemic. This, along with increase in pricing, especially in the group health insurance, will further support the premium growth. Further, increase in yields on debt investments, considering the current rising interest rate environment, will drive the overall profitability for the sector. Improved accretion to net worth, along with relaxed regulations to raise debt and equity, will provide sufficient growth capital, especially for the private insurers in the medium term. Further, easing solvency requirements for crop insurance will free up capital for future growth for the entities who have sizable share in the crop insurance market. Key regulations like removal of product-wise commission caps, implementation of use and file initiative, proposed Bima Sugam platform, are expected to further optimize the distribution network and push the growth further. Overall, we believe improving profitability, more access to growth capital, and increasing regulatory support will boost growth for the non-life insurance sector. Next slide. We'll start with one of the key ratios of the industry, which is the loss ratio. So non-life insurance industry, it's majorly driven by two major segments, health and motor, with each contributing more than 30% of the gross direct premium of the entire industry. In the health insurance segment, the loss ratio peaked during financial year 22 due to COVID-led claims, but moderated in H1 financial year 23 with the easing impact of pandemic. This, along with increased pricing, especially in the group health insurance, and rising awareness, has helped the insurers to increase their top line, benefiting the loss ratio. The second largest segment, motor insurance, reported steep decline in loss ratio in financial year 21 due to COVID-induced lockdown. However, the ratio normalized in financial year 22 with easing restriction on movement. While the pricing in third-party motor insurance is largely regulated, high competition exists in the own damage segment, which puts pressure on the overall pricing in the motor insurance industry. Going forward, we expect the loss ratio in the motor segment to remain largely in line with the past trends. The loss ratio in the crop insurance segment, which contributes to around 10-15% of gross direct premium return, will continue to remain dependent on weather conditions and thus may remain volatile. For other segments, we expect loss ratio to be in line with the past trends, subject to any external shocks. As can be seen from the graph on the left side of the slide, the overall loss ratio for non-life insurers peaked during financial year 22 to 92% due to COVID-led claims, but moderated to 87% in H1 financial year 23. The loss ratio is expected to further reduce to around 85-86% level going forward. Next slide. Coming to the expenses part. The high customer acquisition cost, especially in the retail segment, continue to impact the expense ratio in the non-life insurance industry. As reflected in the graph on the left-hand side of the slide, expense ratio has ranged between 29 to 33% in the past. It reduced to around 30% in financial year 22, however again normalized to around 33% in H1 financial year 23. Going forward too, we expect this ratio to remain largely range-bound. Health insurance industry has relatively high expense ratio as compared to other segments due to its operationally intensive nature from the perspective of claim management, engagement with agency channel, and workflow running with network hospitals. The recent proposed regulations to remove product-wise cap on commission rates and implementation of overall limit on expenses of management to around 30% for general insurers and 35% for health insurers is considered positive for the industry. This will provide the insurers much needed flexibility to push key product segments and to make required investments in the distribution network. Next slide. Yield on investments will benefit from the rising interest rate environment. So with consistent hike in repo rate by Reserve Bank of India to tame in inflation, the yield on debt securities is expected to improve. Further, the insurers have been shifting the portfolio to longer tenor securities as they envisage peaking of the current interest rate cycle. Assuming the return on equity to remain largely in line with the recent past trends, overall return on investment is expected to increase to around 8.9% in financial year 23. Further, favorable regulations on increasing exposure to AT1 securities, rise in exposure limit to around 30% for the overall BFSI industry, increasing investment in InvIT, and relaxed dividend criteria for equity investments will further support the yield over the medium term. Next slide. Increased availability of resources to underwrite more risk. As can be seen from the graph on the left, private insurers with solvency levels higher than 2x have sufficient capital required to achieve their target growth. The public sector, on the other hand, except for two entities, they remain entirely dependent on equity infusion from the government and regulatory forbearance to support the growth. To provide sufficient availability of growth capital, the regulator has come up with a number of initiatives recently. The threshold limit as well as the pre-approval requirement to raise subordinate debt has been waived off. Equity investments are also expected to get a boost, considering relaxation in the concentration and the minimum promoter stake threshold. Also, for the entities having sizable crop insurance in their portfolio, solvency margins are expected to benefit from the recent amendments in the solvency margin calculations. All these measures, along with the expected improvement in the profitability profile, will provide additional growth capital. Next slide. Other growth drivers. Low penetration levels, along with growing per capita income, will continue to provide steady demand for the industry. India's insurance penetration stands quite low at around 1%. Though it has been increasing consistently from 0.7% in financial year 2014 to around 1% in financial year 22, it still remains quite low compared to the world average of around 4.1%. This low penetration level paves way for the consistent growth in the insurance sector in the long run. In fact, IRDA, under its vision of insurance for all by 2047, have taken several initiatives which are expected to further support the industry growth in the long run. Next slide. Industry on the growth trajectory with GDPI expected to grow at double digits. So, impacted by lockdowns during COVID, the growth in gross direct premium income had slowed to single digit in financial year 21, but it has rebounded through increased demand for health in financial year 22. This can be clearly seen from the graph on the left. In the current financial year, the group health insurance segment benefited from rationalization of premium discounts, medical inflation, and enhanced coverage, while the retail health segment growth looks to be normalizing post the pandemic. The government schemes have also increased their share due to Ayushman Bharat scheme. With increased pricing along with rising awareness, support the health insurance, motor insurance benefits from pickup in automobile sales and increased tariff of third-party motor insurance. Stricter implementation under the Motor Vehicles Act will further support the segment over medium to long term. Driven by regulatory initiatives covered above, low penetration, and increased per capita income levels, the non-life insurance sector is expected to grow at around 14 to 15% in financial year 23. Next slide. Favorable outlook for the non-life insurance industry. So going forward, gross direct premium income is expected to grow at around 13 to 15% over the medium term, driven by health and motor insurance segment. Coming to the profitability part, driven by the improvement in the loss ratio along with the rising yield on debt investments. The overall profitability is expected to improve for the sector. Expense ratio is expected to remain range-bound in the near term. However, with the new regulations and with the economies of scale kicking in, we expect it to improve in the long run. Overall, private insurers are expected to report return on equity of around 13 to 14%, while the public insurers' profitability is expected to remain muted. Further, uncertain geopolitical environment, high inflation, rising cost of capital, it can negatively impact economic growth and subsequently the non-life insurance sector. Thank you. Now we move onward to the panel discussion.
Thank you, Neha. A request to all the participants, in case you have any queries, you are please requested to key in your panel. Now, may I invite Mr. Sanjay Agarwal to take over the session, please. Mr. Agarwal is the Senior Director at CareEdge Ratings. He has over 24 years of experience in the field of ratings, banking, and infra finance. Prior to joining CareEdge, Mr. Agarwal worked at ICICI Bank and IFCI. He has a bachelor's degree in commerce, a grad CWA, and a fellow member of ICAI. He's a qualified financial risk manager from GAP USA and a certified financial planner from FPSB India. Over to you, sir.
Thank you, Mridul, and thank you, Neha, for setting the context for these discussions. So before we move ahead, it's my pleasure to introduce the esteemed panelists today. So let me start with a notice that the speakers would provide views on the industry as senior executives of the industry and as industry experts. Hence, this discussion should not be construed as views or position of the companies to which the speakers belong. Again, participants are requested to key in their questions in the space provided. Can you begin with the slides, please? So let me introduce the participants now. Samir Shah is the ED and CF of HDFC ERGO. Samir is a chartered accountant, cost accountant, company secretary, and has pursued CISA from USA. He has rich experience of 31 years in the field of finance and financial services and 16 years in the general insurance industry. He's been a part of the industry level committees of IRDA and ICICI. Samir has won the CA CFO Insurance Sector Award from the Institute of Chartered Accountants of India. For his exceptional effort and contribution to corporate finance, he has been presented the CFO 100 Roll of Honor by CFO India for last 7 years. The company HDFC ERGO has been awarded as the Excellence in Financial Reporting for last 7 out of 11 years from the Institute of Chartered Accountants of India. Next, please. Gopal Balachandran is the CFO and Chief Risk Officer of ICICI Lombard. Gopal joined ICICI Lombard in 2002, the first general insurance company in India to be ISO 9001-2000 certified. Gopal completed his chartered accountancy course in the year 1998. After completing his CA course, Gopal worked in ICICI Bank in the corporate accounts and taxation department for 2 years. As its CFO, Gopal has led ICICI Lombard to many achievements. It was the first general insurance company to be listed in India. ICICI Lombard was awarded the Gold Sheet Award for Best Presented Accounts for FY19 and FY20. Gopal himself has been a winner in the CA CFO Large BFSI Award category of ICICI in January 2021. Next, please. Rajive Kumaraswami is the MD and CEO of Magma HDFC. Rajive is a fellow member of the Institute of Chartered Accountants of India and an associate member of the Institute of Cost Accountants of India. He started his career as a banker and spent first 6 years of his career in project appraisals, corporate funding, and loan restructuring activities. He has been with the insurance industry since its opening to the private sector and has held positions of head corporate center and Chief Risk Officer of ICICI Lombard GIC and Chief Representative of SCOR's SC India Liaison Office respectively. Rajiv joined Magma HDI GIC in June 2016 as its MD and CEO. So next slide, please. So now we begin the questions. The first question is to Rajiv. The regulatory landscape has livened up with the arrival of the new IRDA chairman. So what does your interaction with the regulator or your views in the market suggest on the regulator's vision and methods of raising insurance penetration in India?
Thank you, Sanjay, and thank you to the entire CareEdge team for having us as a panelist. See, if we look at the overall direction of the regulator, the grand vision is at the end of the 100 years of independence of the country, the intent is to ensure that every corporate citizen has a health insurance, home insurance, motor insurance, term insurance, and an accident insurance. So if you look at the broad cohorts in which the regulator is working, one is the entire platform on distribution, where their belief is that the current ecosystem should have the benefit of accessing greater number of channel partners and hence expanding the entire bank assurance and IMF distribution architecture from the current 3 partners to 9 partners each. The second belief is that a country of our size deserves to have more insurers, and hence opening up the entire licensing regime. And you would have seen that there is this recent statement there, 1 new entity has been licensed and there are almost 18 other on the anvil, as well as probably recognize the need that there may be niche players and niche segments who may come in, like what has happened, say, in the banking space, which is small finance banks. So they are looking at maybe micro insurance companies, looking at cooperative structures. So the whole ecosystem and the enabling regulatory framework to allow the distribution architecture to flourish. The second is the aspect in terms of creating bandwidth for the industry to come out with innovative products, not have long waits to launch those products, and have a much larger enabling environment from a sandbox regulation, and also from a distribution architecture, promote the insurtech related initiatives. The last pedestal, or the third pedestal, the way we look at it is look at easing the compliance burden for the industry so that we focus on the development part, while yes, they would migrate to a risk-based governance framework depending on the size of the company. So that's the grand design. And the last is, if all the 3 building blocks work, the access to capital for the industry is made easier. And hence, the whole concept of subordinated debt, no prior approvals, expanding the enabling regulations to ensure people have more access to sub-debt, as well as the access to private capital. Because earlier, there were a lot of the private markets or the private equity investors who had a keen interest to come into the ecosystem as investors. However, they did not, for whatever reason, want to take on the promoter obligations. So there has been an alignment that up to 25% you can come in and still be classified as a promoter, with a relaxation on the lock-in period depending on the maturity of the organization in terms of the age of the organization. The overall approach is participative. It's a 2-way dialogue. And I think it's a very, very refreshing change as far as the overall industry is concerned.
Yeah, I think those are the key words, that the change has been very refreshing and pretty different from the way regulators were dealing with the industry till now. And the speed and the innovativeness which has been shown has been pretty exemplary. So coming to Gopal, are there any risk of disruption from insurance tech players, especially in the non-life segment, given the not so sticky nature of the non-life business?
I think thanks Sanjay for having me on this webinar. And I think when you look at the non-life insurance market, as was initially introduced by Neha, this is a market which is significantly underpenetrated. You saw the penetration levels over, let's say, 2 decades increasing from 0.7% to, let's say, 1% of GDP in terms of gross revenues. And despite that, if you see the extent of underpenetration that exists across segments of businesses is pretty large. I mean, we can go on in terms of the extent of underpenetration that exists. Having said that, I think obviously digitization is the way to go insofar as development of the market is concerned. And when you talk of digitization, it just spans not across sourcing of businesses, it also kind of spans across servicing of claims. And equally, there is a need for every institution or the sector to look at digitization of their internal processes as well. Now that's where you would possibly get to see a lot more competitive element coming into the sector. Now it's up to each of the institutions to decide how do they want to look at insurtech as a key enabler to doing business, or you look at them as one more competitor in the fray. To my mind, I think a lot of insurtechs are operating in platforms or avenues which could act as complementary insofar as the growth of the market will prove to be a great positive. And equally is where I think, as I said, individual companies will have to also keep in mind their own digitization investments into its requirement, and accordingly kind of make the right investments. So I would obviously say that the market has always been very, very competitive, irrespective of whether you talk about insurtech or otherwise. In general, the market has been competitive, as Rajive mentioned, with more number of, let's say, players entering the fray, entering the sector. I think the relative competitive intensity could further get accelerated. Having said that, I think the discipline of writing businesses, keeping in mind underwriting as a focus, will also determine how do you look at some of this competitive elements. So the way we would look at is insurtech is definitely a partner to kind of work with and look for capabilities in terms of where they can bring a differential experience and use it to the advantage, is the way I would kind of respond. Thanks.
Gopal, actually, you made a very interesting point. You actually internalized the insurtech as a business. So you said that either they can be external agencies or they can be your own company where you use a lot of digitization and technology for all the processes. And yes, I mean, the market is competitive, but I think we're looking at other industries and how technology can move out there. So that's my next question for Rajive. So except for a few, insurtech players are not as large as their counterparts in, let's say, the fintech segments. So what do you think are the key reasons for the same, and which kind of insurtech player do you think could become more relevant? Let's say the aggregators or the analytics provider or the niche insurers or whatever. And do you think insurance as a service, I mean, we say banking as a service, so do you think insurance as a service could be available in the near future given the regulator intent to give much more licenses and all that?
So I think the whole way we look at it, Sanjay, is the understanding of the public at large and the industry at large in terms of what is an insurtech player vis-a-vis an evolved player who has digitization as a core to their platform or to their business, right? I mean, if you look at today, most of the insurance players have agent portals where agents can issue policies with customer information, and every insurer would have the ability to switch on, switch off underwriting filters and have pricing at a district, at a vehicle, and maybe even at an intermediary level. So the entire customer onboarding, to my mind, is digitized. It is a question of how much people are probably positioning their company as digitally enabled players. And as Gopal rightly alluded to, your claims need to be digitized. If you today do a scan of the market, you would find that, let's say for motor as a product class, most of the companies would have video streaming as a claims payment facility, which is digitization at its core, instant survey assessments. They would have AI/ML tools for certain asset classes. We know some of the large players have introduced AI/ML in terms of claim assessment on the health insurance side. Companies are introducing RPAs to automate their internal processes. So it's more a questioning of what is insurtech. And I don't think we've reached a stage where today the country has a Geico or a UK Direct Line or an entity of that scale which we can truly call insurtech. I think customer access, customer KYC remains a challenge. And today, given the way the market has evolved, I think the consumer at the end still does rely on the agent. So it is more, at least the way we look at it, is how can you enable your partners to digitize and ease the onboarding process, but at the same time, be ready for the disruption. See, I think disruption is going to be a way of life. And as Gopal rightly said, every company will need to keep its cost structures very tight to make sure that they remain competitive in a world which is constantly going to change. So that's the way we look at, the entire insurtech world at an overall places. But I'll be happy to hear the others' views on this.
So, Samir, would you like to add on to this? Samir, you're on mute right now.
Yeah. Thank you to the CARE team and thank you, Sanjay, and for inviting us to be on the panel. Yes, to a certain extent, yes, I would also echo the views of my colleagues Gopal and Rajive that yes, the insurtech ecosystem in our business or in our industry will have to coexist, and I would say they would be complementing all of us in our business, the way we deliver our products, the way we service our customers. And it is becoming a kind of an inevitable thing that one needs to have it due to the size of the business that we have, the kind of operations we run, especially in our country, which is so large in terms of length and breadth of the country. We definitely need insurtechs and this technology to serve our customers not only at acquisition stage but also to service them. Be it claims journey or be it journey for buying the products or any other servicing needs. So I think it's a kind of a necessity which has now become for the scale and size of the companies which we operate, and hence I think we all will have to coexist in one form or other.
Interesting observation. Actually, all three of you are saying that you actually welcome, indirectly you are saying that you almost welcome insurtech as a thing because it provides a lot of support to the complexity of the business, and the companies themselves are ready in terms of the technology and digitization from end to end, from the customer to the servicing. So interesting observation. So changing the gears now, Samir, the question we have is Indian non-lifers have a very high combined ratio, both at an absolute level and relative to, let's say, the large key European economies or emerging markets. Now, is this mainly due to the extremely competitive nature of the industry, or are there more factors at work? So with interest rates rising, do you think the competition will increase, or will the combined ratio be going up further? How do you see this whole trend?
Thank you, Sanjay. I think it's an interesting question at this point of the industry, where we are looking at also inviting more players into the market. I think, and this is very interesting question. And on the first point of yours as to why are the combined ratios higher compared to our peers in other economies? And the competitiveness, I would say, is there across the globe in all the businesses, including insurance. So I don't think the competitiveness of the business in our country is the only reason for relatively higher combined ratios that we have. I would say there are a few peculiarities that we have in our Indian market today, and which say I would not say justify, or which says that okay, fine, the higher loss ratios are fine for that matter. The first and foremost being the accounting treatment that we give in our country for the acquisition costs. So we don't have a DACing for that matter. And hence, to that extent, our results are also not directly comparable to our peers in other economies in Europe and other emerging markets. And hence, I would say, that is one factor which takes our, combined ratio a bit higher. Second factor which impacts our combined ratio is the nature of our third-party business. The third-party business, as you are aware, where the loss ratios do develop over a period of time, first of all, and after that, the payment cycle also is slightly longer. And hence, the loss ratios in the third-party on an undiscounted basis are on a higher side. And that again, is another factor which takes our combined ratios slightly higher. And if I'm not mistaken, on some back of the envelope calculations done, because of the third party loss ratios and because of this concept, I think the combined ratios are higher by around 300 to 400 basis points at minimum compared to other economies. So these two are the factors which I would say make our combined ratios slightly higher than other economies. Coming to your other point on, I think you spoke about whether the combined ratios, whether they are
rising interest rate.
Rising interest rate would be. Yes, so I would say in India again, looking only at the metrics of combined ratio may not be the only factor one should look at for evaluating any non-life company. So combined ratio clubbed with the return on investments would be return on equity, not investments. Return on equity would be a right metrics that one should look at, and when both looked at together, would really give I would say reasonably good evaluation of the performance of a company or the industry. So return on equity is also quite comparable when we look at, or even better if you ask me, if you look at it when we compare it with the Western world or our emerging markets. One, because of the I would say the investment multiple that we have to our net worth. That is one factor which helps us to get better return on equity. And the higher interest rates coupled with the better investment book multiple also helps us to get a good return on equity. So yes, so the metrics of combined ratio is good for looking at the operating results when you look at the underwriting results. But yes, when you look at it at a company level, return on equity would be a good indicator for a non-life segment.
Okay. Yeah, so 2 points. One, I think, is the conversation in the industry on the IFRS, on implementation of IFRS, which probably will take care of the accounting treatment that you discussed, that probably some amount of difference would come out there. And return on equity even now looks decently okay for the industry as a whole. I mean, that's what we have presented. Good point. So coming back to Rajive, the regulator has been taking several steps, some of which you enumerated earlier. So the product-wise commission cap on products is proposed to be removed, and an overall limit on management expenses. Then, as you said, the number of tie-ups the distributors can have with insurers. So do you expect this to have structural impact on the distribution network, and do you see it impacting the growth of the industry?
So we will, this is something which has just been notified. You have various entities on the distribution spectrum who've taken completely contrarian views, right? You have banks who have just gone ahead with one tie-up and they are happy with one tie-up. And there are entities who may have had their own insurance entities, but they've still gone ahead and had 3 tie-ups. So it will remain to be seen how some of the partners view this. I think from a larger ecosystem, while I think the regulator has done a lot of work to ease the compliance burden from an insurance company point of view, I think there are, if I may use the word, some pain points which still remain when it comes to the corporate agents and the bank assurance tie-up. I think if there is some work which is done to reduce the compliance burden for distributors on that end of the spectrum, especially the banks who are coming in as corporate agents, I think then there could be possibly a little more explosion. Today, at least as we see it, it is an opportunity, but we will need to be a little cautious and see how people actually view this as an opportunity.
So in terms of growth, do you see any impact?
See, the growth, I think if you look at the last 5 years, CAGR industry has been growing at 15%. If you look at the current year, 8-month numbers till November, we continue at 16.5. So I think industry doubling in every 5 years, to my mind, is a given. And I think the opportunity the market itself presents provides immense opportunity for growth to come in. I think distribution would be an enabler to achieve those growth rates. But I think growth is something which we can take as a given for the industry for some times to come.
So coming to Gopal, how do you foresee industry landscape to evolve considering the amendments to the Insurance Act and the IRDA Act? Like significant changes like scrapping of minimum capital, allowing different kind of insurers like captive insurers, composite insurers, which can offer life, health, non-life, all of them. So how do you see the industry landscape to be changing with this?
So that's a very difficult one, Sanjay. If one will have to do prediction of what could happen, right? So having said that, I think let's look at what has happened so far. I mean, historically, if you would have seen, motor has by far been the largest contributor to the overall revenues in terms of premiums. However, if you look at for understandable reasons, health became by far the largest segment in the year gone by. I mean, for both reasons, obviously increased awareness on health, and obviously motor had its own set of challenges. So in terms of opportunity, I think one sees a lot of potential across segments, which are the existing ones, whether it is motor, whether it is health, whether it is across commercial lines. And increasingly, when you look at it insofar as the way forward is concerned, which is the original point that I made, the country is significantly underpenetrated. And that can be gauged by even the existing segments where there are significant levels of underpenetration. And even other segments like, let's say, for example, home insurance. The point that Rajive started off initially with the vision of the chairman. Hardly any percentage of homes in the country is insured. So there's a significant runway for growth, and that could be a change that the sector could actually experience. If you look at many of the matured markets, liability insurance typically forms a relatively large proportion of the overall industry contribution. In the Indian market, while retail liability is taking off in some reasonable form, so far as corporate liability insurances are concerned, still it is not a very large contribution in terms of the aggregate numbers. So that's an opportunity that the market would see, provided we are also able to underwrite the risk adequately in terms of what we retain on the net. The third element, when you again specifically talk in the context of health, what you largely see in the market is hospitalization insurances. A large part of the healthcare spends today is out of pocket, which is not necessarily getting covered in a meaningful form. So that is what the industry could largely expect in terms of landscape changing. We could see a lot more offerings on the OPD space by various players in the market, which again can start becoming to add meaningful contributions to the continued accelerated growth that we have seen on the health insurance platform. So that's an avenue that one would logically get to see in terms of growth. If you look at some of the other points that you made, Sanjay, in terms of freeing up, let's say, minimum capital requirements, in terms of allowing licenses for a differentiated set of players, again, the point that Rajiv initially started off with, the thinking is pretty much on the similar lines as what you see on the banking side. You have different types of banks, which logically caters to different lending requirements. In the insurance market, so far, we have only been seeing largely, let's say, a life or maybe a general and a health. You may possibly come across players which are niche insurance players, where obviously one can expect growth in those segments where they will be operating with. You could expect to see players coming and possibly tapping into increasing penetration for a geography or a territory. That could be a change that one could kind of witness in terms of changing landscape. If you look at the regulator's vision itself, they are equally asking the existing companies to start looking at increasing penetration in certain jurisdictions or territories that they want each of the companies to own. Now, that's a platform by which you can actually start creating a differential edge. So that's a changing landscape that you would see. The enabling guidelines on Sandbox, which was an experimentation initiative to bring about innovative products, already we have seen the green signal being given, particularly on the motor side, with respect to the various Sandbox initiatives that can be now launched on a commercial basis. Now that's a big positive. So that could actually kind of change the traditional motor insurance policy that one would have seen so far. So all in all, I would say the landscape of insurance is, and maybe the last point which I have to also make is, today insurance is being looked at significantly as a risk transfer mechanism. I think going ahead, what you will also see, which some of the players in the market are exhibiting, is to see insurance companies as a risk mitigation partner. And therefore, if they are able to do a lot of value-added services, which will actually kind of play a very important role in, let's say, mitigating or managing the risk of the entities which is being underwritten. And that's again, there is an enabling regulation around that. Now, this is all areas which I would say across product. The distribution part, I think any which ways Rajive covered. And some of the new innovations that we are seeing is how one would expect the landscape of the market to evolve over whatever period one is talking about.
Yeah, I think you pointing out to a huge amount of potential across products and within the existing products also, and probably niche products like the contractor assurance, the one which was launched recently by Bajaj Allianz. So probably some of the risk transfer, risk mitigation products out there. So coming to Samir, the diversified non-life players have not been able to match up pace with the standalone Shahi players in terms of growth and product innovation. So what do you think explains the dichotomy, and how would diversified players be able to, how do they intend to bridge the gap, which could be profitable given that the COVID is behind us? Samir, you are on mute, Samir.
Yeah. So, Sanjay, I get you as what you're saying is in terms of the growth of the diversified general insurance companies when we compare it with the standalone health insurance companies. So, when we look at the matured general insurance companies for that matter, so in them, I think the growth rate, if we look at it and we compare that with the base of the standalone health insurance company, so I think that we will have to keep in mind when we compare the growth rate of both in terms of kind of maturity of both the companies, the size of both the type of the companies is also involved. So that is one. Secondly, the diversified general insurance companies are concerned, they operate in all the segments which are impacted by the growth of general macroeconomic environment in the country, and hence they do serve the larger segment of the economy. And yes, to certain extent, they would also reflect the growth in the economy in those segments also. Standalone health insurance companies, yes, they only reflect the health insurance segment part of it, and which, yes, in these times has been in limelight, and the growths have been in upwards of 30 or 35% for that matter. So I think to that extent, when we compare the growths of both the segments, I think we will have to keep this factor in mind. Another element which I observed that you were making were in terms of the innovation aspect. So when we look at the health insurance products, I think these are most of these products are standardized products. The kind of offerings which needs to be given has also been specified by the regulator in terms of what kind of coverages are required. So in terms of indemnity products, I would say 90%, just to give a ballpark number, of the offerings are the standardized products, and hence the innovation would only come in terms of add-ons which are offered by these companies. And I think in terms of the companies which are diversified companies, they are also providing innovative products for that matter. So in terms of the product features, yes, there could be something more which can be done, And but I would say that 90% of the offerings would remain consistent. Coming to innovation, more than the innovative products or the terms of the coverages which are there, I would say the differentiation will only come in the way the customers are treated, the kind of servicing which is done, and the innovation would more probably come on that segment, and that is where diversified insurance companies are also not behind. And more in terms of how the customers can access the products of the insurance companies, how they can buy the products, how they can compare the products, and even how the servicing is done once the claims are registered by these customers, and whether they are able to track these claims more specifically in terms of health claims, when I think the customers are more in need of the settlement at fast pace, and what kind of treatment they get at the time of claims. So I would say the promises which the insurance companies make, the moment of truth comes only when the claim is there, and hence I would say innovation would more be required in terms of servicing, and when the claimant really needs the insurance company the most.
Okay, so you're saying that, yeah, please go ahead.
Yeah. So for that matter, just to give an example of the product that we have launched as HDFC ERGO, the Optima Secure, and there I can tell you that the innovation which one looks at, everything one can find in that product. And in the first year of launch itself, we could see customers taking that up, and over 100 crores of premium was done in less than a year, I would say, in 8 or 9 months. So I would say that diversified companies are also up there on the curve, and servicing would be more important if you ask me than the product features.
Okay, so you are saying that it could probably be just a moment of time when one particular asset or the classification is under greater limelight. So hence the niche players catering to that segment probably have the moment in the spotlight. But diversified players are throughout all classes and throughout all opportunities. So yeah, that's correct. So now we move on to Rajive. The growth momentum in the domestic automobile sales has picked up post-pandemic, and then along with the increase in the third-party motor insurance tariffs, has supported the growth premium in this first 8 months of this year. However, there's a lot of competition in the own damage sector. So how do you think this growth trend will pan out, and what do you think would be the loss ratios given the pricing constraints that are here?
It's an interesting question, Sanjay. I think the profitability pressures have always remained on motor. And if you dovetail what is likely to happen in motor with, say, the regulator's intent with new licenses to come in, there is a natural tendency for the newer players to gravitate towards writing motor business because that's cash flow business, and hence the profitability pressures will be there. Having said that, I think there are a couple of things which from an ecosystem have been created, which have helped, companies also get persistency on the motor side, especially with regard to TP, which is on the two-wheeler business as well as the private car, when the regulator launched the 1+3 and the 1+5. If you would have seen the working committee report, there is a direction where we can even on the renewal portfolio look at providing some long-term products. But I think I would just like to give a word of caution there that as Samir alluded to, what we are taught in class 11 and 12, that you match your expenses with your revenue. Unfortunately, the general insurance industry doesn't follow that. Forget about the long-term products. It's not even applicable on annual products. So the accounting charge on long-term products would be far, far more significant. And just to give you a sense, if you look at March, the industry was sitting on almost 65 to 70,000 crores of UPR, on which all costs are incurred. And I'm not even getting into advance premium on long-term products, which the industry is probably sitting on. This accounting anomaly is something I think the regulator will need to look at very seriously with enabling changes in taxation rules. Having said that, I think companies have the ability to analyze their own portfolio. When it comes to own damage, you've typically got a tail of 24 months. So even if you look at some of the new age companies who've been in existence, say for a decade, compared to say some of the larger players who've been in existence for 20 years, people on OD would have the ability to price products far more discerning way than TP. The other thing which is happening from a structural change is if you look at say 5 years back, say 2017, the OD-TP mix was skewed more towards OD. Today, if you look at it, the skew is more towards TP. In the industry is probably less than 40% OD and 60% and up towards TP, where I think reserving certainty is increasing. And in a rising interest rate regime, while there remains a reserving volatility, but it gives you the advantage of float. So if you look at an overall level, the industry on about 1 lakh crore of capital that has been deployed, about 4 lakh crores of investment book, which is the float that Samir had talked about. Whereas if you look at the same kind of float on health companies, the float will be much lesser because health companies have a much shorter tail. So for them, the combined ratio will become important. So you cannot afford to run your book on high combined ratios. You need to necessarily have range bound combined ratios because you don't have the benefit of thing. But to answer your question, I think competitive intensity on motor has been there. It will continue to be remaining there.
So interesting observation. 60,000 of unreserved, unexpired reserves would probably be something around, let's say, at a 30% ballpark figure. About 18%, 18,000 crores of, let's say, cost pre-booked. Again, at the industry level, that would be about 15 to 20% of the addition to the net worth of the industry. So, interesting observation.
I think if the regulator is able to address this, rather than the solvency relief that has been given on crop and the sub-debt, this one change will release far more capital for the industry than all these changes put together.
Okay. Yes. So the noise on bringing IFRS into the accounts. Correct. So there's a question for Samir that currently the shareholding is largely with through equity stake by the promoter, but with the easing of the norm we discussed in terms of bringing in external investors, 26% and all that. So can we expect the insurers to go more insurers to go for listing? How do you see the landscape?
Thank you, Sanjay. I think it's an interesting question and very topical in recent times. I think past few years, I think we have seen insurance industry undergoing some kind of a consolidation.
Sanjay, I'm not able to hear Samir unless...
Yeah.
Okay.
Samir? Yeah, I think we probably have lost Samir. So, Gopal, yeah, there's a question. Samir, can you... We lost you for some time. You're on mute right now. We lost you for some time.
Hello?
Yeah.
Sorry. I think there was some technical issue. So what I was saying is that recently the amendment which are proposed by the regulator in terms of allowing promoters to go up to 26% for the listed and 50% for unlisted, and allowing investors to go up to 25% singly and jointly up to 50%. I think this changes, would really, ease up the accessibility of capital for the companies. And definitely, this is a kind of a nudge which the regulator is making to the companies to get listed. Like you would have seen in BFSI also, once the NBFCs reach a particular scale, I think they get a consistency of results, they do get listed. And in terms of general insurance companies, at least I could say that now over 2 decades, the industry has matured enough. And the companies have also realized, what kind of models do work and what kind of models are required, to be in the business for long term and for consistent results. So I think, this is the right time for the insurance industries to, get into different kind of investors and also, get listed. And I see as a trend, that, over a next, couple of years, we would see, large number of investors coming in the Indian market, considering the kind of potential that the industry also offers. Again, going back to what Gopal said in terms of the penetration of, about 1%, and also out-of-pocket expenses on the health side being around, 55% of the total spend. Government spending also being around 3% of the total, allocation. So I think all these factors, do bring into forefront the potential of the industry, and hence the attractiveness for the investors. And once the companies are listed, I would say it would bring in more, discipline, governance to the industry. And hence, I think the vision of the regulator and the new chairman is, I think, absolutely dot on. And I know this would bring in a lot of respect also for the industry, if you ask me. So I see that, apart from, the top GI company, top public sector company, and a top reinsurance company being listed, and also the health insurance company being listed, I think that's just a beginning, and we would see a lot of more companies getting listed in the times to come.
Okay, so you're saying it's the right time to get listed, and there's already precedence in the market in terms of the way the investors could value them and understand them. Okay, so Gopal, the threshold on raising equity and debt from the investors has been relaxed. So what quantum of capital do you expect to be raised by non-life companies?
So, Sanjay, that's an interesting point. I think the way I would kind of respond to it is, if you look at the regulatory minimum on solvency, let's say it's 1.5 times. Now, if you look at the industry as a whole, obviously COVID had a share of its own impact on this solvency numbers as well. The industry was slightly operating pre-COVID the year before at an aggregate solvency of roughly about 2 times. Now that number, if you see for FY22, has actually come down to about 1.7 times or thereabout. So obviously COVID had its own share of losses on the solvency as well. Having said that, I think if you look at the overall market, and I'm talking about for, let's say, over last 14-year cycle, which is from the time the industry was deregulated from tariff from 2008 until 2022. While the point that Samir also made and Rajive also made, the industry has grown reasonably well at a compounded rate in top line of almost about, let's say, 15-16% thereabout. However, if you see the relative outcome in terms of underwriting, the combined ratios have actually got far more deteriorated. It was close to about 112% way back in 2008. That number at the end of FY22 was 119%. Of course, as I said, COVID would have had its own share of losses, but even let's say 1 year before that, the industry combined in FY21 was roughly about 113% or thereabouts. Effectively, no change in combined even after 14 years of, let's say, the market deregulating from tariff. That speaks of a couple of impacts, because one is you get growth capital through incremental investment coming in from various classes of investors. The other is internal generation. So to my mind, it has to be a combination of both. While what the regulator has done is obviously kind of enabling far more access for companies to be able to raise capital in times of need. But what is more important is for companies to seriously look at driving businesses or underwriting businesses far more profitably. that would by itself generate the necessary growth capital, which will help them to possibly start becoming far more self-sustaining. So that's the way I would kind of look at, while the change in the extent of norms for raising capital has been changed. But just as a thumb rule, if you look at, for every, let's say, 100 rupees of business that the industry has to write, roughly you need a capital of close to about 25 rupees. It's 1 by 4. Now you can put a number in terms of whatever growth that one is expecting. As Rajive mentioned, this industry is rightfully poised to at least grow in the range of 15 to 20% over the foreseeable term, which is what the industry has demonstrated over the last so many years. And therefore, corresponding to that, the requirement of capital would arise, which will be a combination of both the change in the regulation that has been brought about by the regulator, and more importantly, I would say the internal self-sustaining surpluses that companies will need to start to kind of deliver. So that's the kind of capital requirement that the market is expected to.
So yeah, Gopal, Gopal, I don't know. So Samir, probably you can also take this question. We are having it from the audience. What sort of demand do we see from life insurance segment in the bond market in FY24? What is the debt market borrowing demand from the life insurance sector in FY24?
Just to understand the question better, I think this is the demand on the bond market in terms of the debt investment side, or
quasi-equity, the subordinate debt.
So subordinate debt. Yeah, I think the kind of relaxation which the regulator has given for the subordinated debt, and the way it is panning out now, I would say the kind of capacity that has been created through this relaxation is equal to the amount which was already there. So I think the capacity of the general insurer to borrow by way of tier 2 capital has increased twofold, and this is really going to give a huge boost to the solvency for this sector. But yes, the caveat is that one needs to be really profitable after payment of the interest and dividend. So one will not be able to pay interest if one is not making profits. So that will have to be looked at. Only the companies who are able to make profits will be able to raise the capital as earlier also. But yes, it has increased the accessibility, and hence definitely the bond market would see the more supply of the non-life bonds in the market for that matter.
Okay. So do you have any number on what is the outstanding debt?
Not really, Sanjay. At least I can't get it immediately.
Okay, so no, we'll work on it.
Yeah, we'll have to.
Yeah, so the interesting point you said is actually, that's as a rating agency, that's what concerns us. So till now, IREDA has been approving payments for interest and dividend even in cases of losses. Yeah. So the subordinate debt or the preference capital which the companies have raised. Now IREDA has allowed the companies to go in for those instruments without seeking its approval.
Yeah.
But in case of a loss, they still have to take the approval from the IREDA. So do you think that structure will change where as of now only solvency was looked into and then the approvals are being given, but now that they did not take the approval while raising the debt, so will they want the companies to be more responsible?
Definitely, Sanjay. I think, as I said, that requirement was earlier also there, that the approvals were required if the companies were not making profits and they still wanted to distribute interest and dividend. So yes, so this all the reforms which the regulator has undertaken are in the direction of ease of doing business. That is for the companies to raise tier 2 capital and who have capacity to service them. Secondly, this will also strengthen the companies in the times to come, and this will help the companies to even grow faster. the deserving companies will be able to deploy capital in a right direction and to write more businesses, and thereby increase the penetration of insurance in the country. And thirdly, by asking approval from the regulator for distributing interest where they are loss making, they are also taking care of the interest of the policyholders. And hence, I would say, the regulator is working, 360 degree in all the direction. One, strengthening the companies, ensuring penetration, and also ensuring the policyholder protection. So I would say this is again a win-win for, right kind of companies.
Yeah. So I think we already overshot. So I'll just take 3 short questions. So
Yes.
Rajive, what do you think would be the headline growth in the net insurance premiums for the industry for the next 3 to 5 years?
Would peg it at 15 to 20 at the same level which Gopal also mentioned.
Okay. And Gopal, what do you think would be a reasonable estimate for industry as a whole in terms of loss ratio for the next 2 to 5 years?
So Sanjay, the way I would kind of put it is I would kind of not necessarily do crystal gazing on loss ratios. I think I would say that the industry needs to get, as I said, more disciplined on combined. If the industry as a whole is able to operate and get the combined better from the current levels of 119%, that to my mind will be a great positive in the long-term structural growth for the market.
Okay. And Samir, what do you think is a reasonable landing estimate for ROEs for the next 2 to 5 years again?
Yes. So ROEs, I would say, post-tax could be anywhere in a ballpark of 20%.
Pardon?
20%.
20%, okay.
Yes. So 15 to 20% is the ROE, target that a matured general insurance companies can, definitely achieve.
Okay. So great, gentlemen. This was a very informative session. We have many questions from the from the audience, but probably we'll direct it to one of you, means a couple of questions to each one of you, and get the answer, and then respond to the respondents. And I think that's the way, because we already shot the time by 6 minutes, and I think it's we time to now wind up. So thank you very much for joining us out here in this panel, and we thank the audience for patiently going through the proceedings. And now I'll transfer this back to Mridul to take it on.
Thank you, sir. Thank you for moderating this session, and thank you, Neha, for the presentation, and to all our guest speakers for their insightful views, Mr. Shah, Mr. Balachandran, Mr. Kumaraswami. It was a privilege to host you. And thank you to all the participants for taking a time out and being a part of this Care Ratings webinar. We look forward to your feedback, suggestion in the feedback mail, which will be coming no sooner the webinar ends. Thank you and goodbye. I request the tech team to log off, please.